Fraud and noncompliance with laws and regulations represent significant sources of audit risk and require careful consideration throughout the audit engagement. International standards on auditing, particularly ISA 240, the auditor's responsibilities relating to fraud in an audit of financial statements, and ISA 250, consideration of laws and regulations in an audit of financial statements, establish the auditor's responsibilities for identifying and responding to risks arising from fraud, error, and illegal acts. Fraud involves an intentional act by management, employees, or third parties designed to obtain an unjust or illegal advantage through deception, whereas error arises from unintentional mistakes or omissions. Because fraudulent activities often involve concealment, collusion, document falsification, or management override of internal controls, they present greater audit challenges than unintentional errors and require auditors to maintain an appropriate level of professional skepticism throughout the engagement. The identification of fraud risks has a direct impact on audit strategy and the extent of audit work performed. Where the risk of material misstatement due to fraud is assessed as high, auditors should modify the nature, timing, and extent of audit procedures to obtain more persuasive audit evidence. This may include increasing substantive testing, performing procedures closer to the reporting date, expanding sample sizes, obtaining external confirmations, involving forensic specialists, or performing unpredictable audit procedures. Particular attention should be given to significant accounting estimates, journal entries, revenue recognition, related party transactions, and unusual or complex transactions that may provide opportunities for earnings manipulation or asset misappropriation. The audit strategy should remain sufficiently flexible to respond to new information obtained during the engagement, allowing additional procedures where unexpected results or inconsistencies indicate elevated fraud risk. Fraud may occur through fraudulent financial reporting or misappropriation of assets. Fraudulent financial reporting often involves intentional manipulation of accounting records, omission of transactions, inappropriate accounting estimates, or deliberate misapplication of accounting policies to present a misleading financial position or performance. Asset misappropriation includes theft of cash, inventory, fixed assets, or other company resources through schemes such as payroll fraud, fictitious suppliers, expense reimbursement fraud, or unauthorized use of company assets. The auditor should identify fraud risk factors arising from incentives, opportunities, and rationalization, collectively known as the fraud triangle, when assessing areas susceptible to material misstatement. Recognition of these factors assists the auditor in designing appropriate responses and allocating audit resources efficiently. The primary responsibility for preventing and detecting fraud rests with management and those charged with governance rather than external auditors. Directors are responsible for establishing an effective system of internal controls, promoting an ethical corporate culture, implementing appropriate segregation of duties, monitoring financial reporting processes, and maintaining effective risk management procedures. Strong governance structures and effective internal controls reduce opportunities for fraud while encouraging accountability throughout the organization. Management should also establish whistleblowing arrangements, fraud reporting mechanisms, and appropriate disciplinary procedures to discourage unethical behavior and detect irregularities promptly. Internal auditors play an important role in supporting fraud prevention and detection by evaluating the effectiveness of internal controls, assessing risk management processes, monitoring compliance procedures, and investigating weaknesses identified during operational reviews. Because internal auditors operate continuously within the organization, they may identify unusual transactions or control deficiencies before external auditors conduct their annual audit. Internal audit assignments frequently include fraud risk assessments, operational audits, compliance reviews, and recommendations designed to strengthen internal control systems. Nevertheless, internal auditors remain part of the organization's governance structure and do not provide the same independent assurance as external auditors. External auditors have a different but complementary responsibility regarding fraud. Their objective is to obtain reasonable assurance that the financial statements are free from material misstatement caused by fraud or error. Auditors are not responsible for preventing fraud, nor can they guarantee that all fraud will be detected due to the inherent limitations of an audit, including sampling, management override, collusion, and the persuasive nature of audit evidence. However, auditors must assess fraud risks, discuss fraud susceptibility among the engagement team, inquire of management regarding fraud risks, evaluate unusual journal entries, assess accounting estimates for bias, and respond appropriately where suspected fraud is identified. Where fraud is discovered, auditors should evaluate its impact on the financial statements, communicate significant matters to those charged with governance, and consider whether additional audit procedures are necessary. The auditor also has important responsibilities regarding compliance with laws and regulations affecting the entity. Laws and regulations may have either a direct effect on financial statement amounts and disclosures, such as taxation and pension legislation, or an indirect effect on business operations, including environmental regulations, health and safety legislation, employment law, and anti-money laundering requirements. The auditor should obtain a general understanding of the legal and regulatory framework applicable to the entity and perform procedures designed to identify instances of material noncompliance that could affect the financial statements or the auditor's report. Discussions with management, inspection of legal correspondence, review of board minutes, and inquiry of legal advisors may provide evidence regarding compliance matters. If the auditor identifies or suspects noncompliance with laws and regulations, appropriate action must be taken depending on the significance of the matter and applicable legal responsibilities. The auditor should obtain an understanding of the circumstances, discuss the issue with management or those charged with governance, assess the impact on the financial statements, and determine whether additional disclosures or provisions are required. Where management fails to take appropriate action or where legal obligations require reporting, the auditor may need to communicate the matter to regulatory authorities or consider withdrawing from the engagement after obtaining legal advice. Effective consideration of fraud, laws, and regulations therefore supports audit quality, enhances stakeholder confidence, and reinforces the auditor's role in promoting transparency, accountability, and integrity within financial reporting.